Mic is on now. Can you hear me now?
Yes, loud and
Okay.
clear, sir. A very warm
Thank
welcome,
you
sir.
very much. Should I address you as Prince or anything else? Do you like me to address you too?
Sorry, sir. Come
I
again,
thought,
please.
should I address you as Prince?
Yes, sir.
Okay. Okay. Thank
Thanks.
you.
So, guys, today we have with us Krishna Kumar Karwa, sir, founder and managing director at MK Global Financial Services, a distinguished rank holder from ICAI. And sir has got over 3 decades of rich experience in every facet of the financial markets, be it research, equity asset management, and corporate advisory division. So today we would be discussing about, although we'll have a broader discussion over the framework which sir uses. Uh, Apart from that, the very important aspect of investing, which is selling. So we'll be focusing more on that because as most of us experience that selling always comes with a regret, right? So there is no set criteria, but broadly how we can improve our selling decisions can surely help us become good investors. So I would request you in the opening note to tell us about how your journey in the financial market started and how it had evolved over a period of last 30 plus years.
Thank you, Prince. Thank you for hosting this session and inviting me to chat up with you and all your listeners and followers. And so I think let's put it this way that this journey of investing started right since I was, say, the years 14, 15 years of age because my dad was an investor in stocks at that point of time, and so used to see a lot of annual reports regularly coming home in the post. And so you get interested in reading, and then did my CA, and that interest continued. And yeah, then started the firm, and this interest kept on increasing, evolving. Basically, I would say is that inherently how companies, businesses work, and how that finally boils down into numbers, financials, and how that gets reflected into stock price. So that was a journey which got started very early, and it has kept on evolving and added many more facets to it over the time. But yeah, so last say 40, 45 years, uh, seen the evolution of the market, and still evolving as an investor, let's put it this way.
Great, sir. So, sir, I mean, when we broadly talk about the process and framework, which is very instrumental as far as any form of investing is concerned, right? So, please guide us, like how it start for you, starting from idea generation to further due diligence and coming to a point where we like keep companies in our watch list and.
So I think, Prince, I think the way to look at it is that investing is basically about looking into the future, as all of us know. So it's not about what is happening currently, but what you anticipate will happen in the economy or in sectors or in companies, say 2 3 years down the line. So that is first thing is that you try to do some crystal gazing in terms of in future based on various macros, which could be local, which could be global or company specific. So first of all, I think let's put it this way that uh, you try to understand the opportunity size itself. Is how big is the opportunity in the sector that you think can evolve, and once you get the sense of the opportunity, then you try to work downwards in terms of various companies which can possibly be uh, which can benefit out of the about the emerging opportunity. So the opportunity size has to be big enough for you to be able to invest in a few good companies in that sector, and then the usual thing follows into place, which is about trying to assess the management capabilities, trying to assess the financial strength of the companies, or how they, and the hunger in the management, etc. And then you try to invest. But the trick is that typically when you're trying to do an assessment of zeroing on which companies to invest in, initially I think you should be looking to invest in the top 2 3 companies in that sector. And then once you believe that the sector has your assessment of the sector growth opportunities are coming right, then maybe you can go down the curve into investing in maybe the tier 2 tier 3 companies which are relatively undiscovered and where the valuation would be much more attractive. But initial round, you should possibly look to invest in the stronger companies in whichever sector you believe has got very good growth opportunities. And once you get the confidence, etc., then you move down the chain. So, to answer your question, I think the most important thing is your assessment of the investment opportunity itself, the size of the opportunity. Then comes the zeroing in on various companies, and obviously, whenever you're investing in, you have to continuously keep an eye on the valuations at which you're buying the companies, because at the end of the day, you're buying a business for a longer time frame. So if your entry valuations are attractive, then I'm sure you will be able to make returns. Otherwise, if you are buying businesses at very obscenely high valuation, then maybe your assessment of the opportunity may be there, but your returns may not be meaningful.
Right, sir. And sir, when we talk about the expectations from the market, right? Although people normally have unreasonable or say too high expectations. So if I were to ask you,
Mhm.
like, not the exact, but how you rate, what should be a reasonable expectation from the market one can have to start with?
Yeah, I'll put it in 2 ways. Like, if you are a direct investor, which means that you are making the effort to research the sector, the research the companies, and then trying to uh, invest, then your return expectations should be higher than when you are giving your money to be invested in a say a mutual fund or a PMS, etc. So one is there is a distinction between your return expectation when you give your money to be managed by a third party, by a professional investor, versus you doing the effort on your own. Because when you do the effort on your own, uh, your risk appetite, or rather your ability to take aggressive decisions also is much more, depending on how you assess your own risk appetite. But having said that, the rule of thumb is that 2 3 things decide basically your return expectations. One is what is the risk-free rate of return, so which is say currently say your G-Secs are say around 7.5%. Plus, if you add for the risk that you take by investing in equities, say 5 6%. So typically, if you look at it that from that perspective, then a 15% kind of a return in the current interest rate environment should be a very reasonable rate of return to expect from investing in equity. Even if you look at it from the other way around, which is your GDP growth, the nominal GDP growth is say the real GDP growth is say around 6 7%, and then you add inflation, which is 5 6%. So corporate profits would tend to grow at around 12 to at least maybe 3 4% more. So 15 to 17% corporate profit should grow. So your portfolio also should reflect that growth. So 15 to 18% kind of a return if your portfolio is able to make on a sustainable basis, I think you should be very happy. And again, if you don't sell the stocks, and then there is a benefit of tax also. So versus you can possibly make 15% compounded, and maybe you'll end up paying tax after 5 10 years when you sell your portfolio. So that also helps you. So 15 16%, 15 to 18% compounded should be a good return. And if you're an exceptionally good investor, then I'm sure you will have many winners in your portfolio, which will certainly take you above high double digits, or rather high 20s also. But for an average investor, a 15 to 18% kind of a compounded return on an equity portfolio, I think he's doing a good job and a far, far superior job than investing in fixed income.
So true, sir. And sir, mostly what I've seen is you were talking about the average investor. The main thing they struggle with is the portfolio construction, right? Although there are many approaches to it, no right. We can't say one approach is right or the other one is. But if we talk about like how you approach portfolio construction, and on the top of that, there are various things in the sense like if somebody has been investing for over a period of time, they have some sense, and somebody who is just beginning or maybe to start with has a different approach. So on those lines, how one should be approaching a proper or say ideal portfolio construction, which can size up over a period of time, sir?
Yeah, I think, Prince, I think one is before one should be able to assess oneself very well, which is that okay, uh, what is one's risk appetite? How does one look at mark to market losses? What is the patience level what one has? I think one before we look at construction of the portfolio, you should have a very good idea about yourself. Is that okay? It's very good to say that a stock will become 3 times in 5 years, but do you have the patience? That one should assess. Or if the stock after you have bought it is correct, it corrects by 20-25%, and do you have the ability to at least take that mark to market loss? Because uh, some people have that appetite, some people don't have that appetite, and plus alternate use of money at that point of time. So what kind of the portfolio that you're creating, can you ignore it, or rather you don't require that money for what time frame? So all those things are very imperative before you start constructing a portfolio. And once you start creating a portfolio, I think the typical rule of thumb that one should follow is that you should, after having done your research, etc., on the various stocks that you would want to buy into, uh, typically that position should be at least 3% to start with, 3% of your overall portfolio. And then if you think over a next 6-12 months that the stock is moving in the right direction, that you think, or the delivery of numbers, etc., is coming into place, it should at least 3 to 5% should be your opening bet or opening investment, and then you allow it to ride based on your assessment of how the portfolio, how the stock is performing, etc. So I think most important is that understand yourself first, then have a right bet size is very important, because if your assessment of a stock is correct, but if your bet size is small, then the impact on your portfolio will not be there, and the meaningful impact on the portfolio will not be there. So it is very important to take a right size of the bet. Having said that, then there are other things which are important, is that what kind of concentration, sectoral concentrations that you are going to take. I mean, okay, today you may like the defense sector as being the next sunrise sector for India for next 3-5 years, but you cannot have say 75% of your portfolio in one sector. So I think that is also important, is that uh, it should you should be able to spread your bets across 3 to 5 sectors which you believe will outperform the overall market, which will absolute returns, and which you believe you understand also. Sometimes it happens that there are some tricky sectors like pharma, etc., where it is very difficult to possibly understand the subtle nuances. Now, the sector may do well, but if you are not able to understand how various companies' behavior is there, then you might as well keep your powder dry for investing in those segments of the economy which you think you can understand better. So those kind of sectoral allocation is also very important. But for an individual investor, I think if he is able to have a relatively more concentrated portfolio, which means have maybe 15 to 20 stocks max, that should be a good way of tracking your portfolio and growing your portfolio. And the trick obviously is that once you have constructed your portfolio, you should, at least when you're buying a stock, you should have a note on why you have bought a stock, which means what are the various reasons you believe that the company will perform in a particular way in the coming 12 months, 24 months. And then every quarter, every 6 months, you review that. So that if the stock price goes against you, at that point of time, you should not get panicked just because that the stock price is down. You should revisit the notes that you have prepared. Okay, why did I buy this stock? Versus that, what has changed or not changed? So that there can be further conviction to further add to that position that you have created or hold on to that position that you have created. So it's very important to make a review of what you should know why you have bought. You should note it down and have a you have your own notepad or something, and then keep on reviewing those reasons for buying that company before you decide to sell, either to book a profit or book a loss, or because there is change in the fundamentals, etc. So portfolio creation is an evolution, but broadly these are the simple parameters. I think if you follow, I'm sure it will be very helpful.
And sir, you just touched upon a very important concept. So adding when we talk,
Sorry,
am I audible?
I missed. I couldn't hear you what you
Okay.
said.
So, sir, basically, when we talk about averaging up or averaging down, right? So the house gets divided. Some
Mhm.
people are have a belief that the averaging down is not a right approach, and some are of the opinion that averaging up is a better approach. And obviously, behaviorally, as you were saying, that, that there is a normal tendency when we talk about average investors that they have some price anchoring, and they normally do not average up, and they average down. So any nuances around that, like how you approach both of these?
See, I think that's what I said. That one is that before you invest, you should have a very high conviction level on the fundamentals of the business that you're investing in, okay, and the associated valuations. I think once you're clear on that front, but yes, you always keep your powder dry to maybe add more position depending on how the market is reacting, or there are new developments in the company in the coming 6 months, 12 months, etc. But I think if the stock price is moving up and there are more news flows, etc., which gives you further conviction, then there is no reason why you should not average up, because at the end of the day, you have entered the the company or the stock at a at a valuation which you thought is attractive, and now the stock price is all market is also recognizing that. And if your portfolio size allows you to increase your bet size on the portfolio on the stock, then you should certainly do that. And similarly, on the if the stock price is corrected, but if you believe that the fundamentals remain as strong as they were earlier, and there could be some market correction, or there could be some selling which is from some institutional investor, or that kind of a reason which is not connected to the fundamentals. And if you have the ability to invest, and if you think that you can take a higher position, you should certainly look to average down also. So both the theories work. I mean, it is all depends upon the fundamental understanding of the business and your conviction levels. It, that is what it is. That the just because the stock price is corrected 10, 15, 20% after you have bought, that shouldn't panic you. And if that gives you an opportunity to build a further position, you should certainly do that. I mean, my experience is that no investor, or at least I have never done that. I don't buy my full position in one stroke. It is built up over a period of time based on how the fundamentals of the company are panning out as per my understanding and my expectations. The stock price could go up, the stock price could come down, as long as the fundamentals and the valuations are in sync with my understanding. And I think it has worked reasonably well. So investors, if they can do that, nothing like it. But yeah, it's a very difficult for most investors to invest when the stock prices go up. I mean, they tend to book profits rather than tend to double up their position. Let's put it this way.
Right, sir. And you touched upon the very important aspect of behavior, and which brings the concept, like these days onboarding clients and client communication are very important aspect. So if I were to ask you, sir, like how it goes at MK Global, the client onboarding, and on the top of that, how important you feel the client communication is, so as to bridge the behavior gap, basically.
No, no, I think we have touched upon a very positive and very important point. I think the most important thing is right. I mean, setting right the investor expectations. So normally investors, I mean, when they get onboarded, what is their return expectations by investing, and what is the time frame that they are looking to earn that returns? And if the return expectations are not in sync with what we believe we can deliver over a 3 to 5 year period, then we might as well not onboard such a client, or I might as well not onboard that client, or give a logical reasoning why we believe that his return expectations are possibly out of sync with what a normal fund manager or normal can deliver. So return expectations and the time frame also, because if the invest this is not an Excel spreadsheet business, or this is not where every quarter is like in fixed income you'll get a return every quarter. So all those things have to be explained to the client, that the returns can be back ended, which means that for 6 months, 9 months, 12 months, their portfolio may show very meager returns. But and in 3 months, you'll get all the returns, which will again which will give you the expected return on a compounded basis. So I think those investor education is very important. That any investor coming in should not expect that he will earn a particular rate of return every quarter, the way he earns on a bond portfolio or a fixed income portfolio. I think that first that mindset has to be out. And yes, also it is very important to teach the investors, or that there is a difference between actual loss versus a mark to market loss. Because sometimes, yeah, you create a portfolio, and for various reasons the portfolio may be down by 5, 10, 15%, but that doesn't mean anything. That's just a function of demand and supply of the various stocks at that particular point of time. And until unless you panic and you sell, actually there is no loss on your portfolio till you don't sell those stocks. So and this distinction between mark to market versus actual loss is something which many investors don't understand. So we need to uh, teach them about this difference, that not to panic when there is a mark to market loss, etc. So these are the important communications that we follow when we onboard investors who are new to the equity market, who come from a non-equity background, maybe real estate, maybe fixed income, those kind of backgrounds. As far as investors who are aware of the equity market broadly, etc., I think we just need to get their return expectations right. I have a simple philosophy is that if there is a businessman who wants to become an investor with us, and I try to, and if their return expectations are some, say for example, 30% return annualized, I ask them a simple question is that does your business earn that kind of return? And if he says yes, then I say then don't come here, because this market is not going to give you that kind of returns consistently. You put all your money in your business. So, but that communication has to be very clear, that this kind of return expectations also basically opportunity cost. If he says that he is coming to the equity markets to earn 20% returns because his business is earning him only 10, 12%, then yes, we can work on it. But if he's already earning 30% return on his portfolio, on his business, then I can't add any value to him. I think those kind of communications are very important. And I think if you do that consistently, there is no heartburn at the end of a particular time period.
So true, sir. So true. So, sir, basically, what we, when it comes to investing, the type of mistake we make at the start of the journey are different. At some later point in time, we tend to be more on the errors of omission, to say. So, how had been your journey on mistakes? Because learning from mistake is something which can uh, improve upon our investing, and not repeating the same set of mistake is what investing is all about.
Yeah, so I'll put it this way that, I mean, let's put it this way that, as I said, that you should first of all have a recording of why, or recording in the sense some noting of why you have invested in a particular company. And similarly, whenever you are exiting that company, whether you're booking a loss or booking a profit, or whichever way it is. So why have you sold that company? You should again record that. And so maybe once you go back to your notes, you will possibly realize that you invested in a company for a reason A, and the stock price have done well maybe for a reason B. But now, and so you this introspection helps you a lot in terms of which decisions of yours have gone right. So what are the key things? So you will, and which decisions of yours, or which investment decisions of yours have gone wrong, and that will give you an insight into your own capabilities. Okay, okay, which are my blind spots I don't understand, which are the sectors I am unable to understand, and which are the sectors where I seem to be having more success than normal. And that will, so that journey, that is the way you evolve as an investor. So you start playing the game to your strength and not worrying about the ideas that you have missed. As long as the ideas that you invest in, they deliver superior returns. So I'm not so worried about error of omission. If I miss an idea, it's no problem, because I believe that always there are new and new ideas which keep on coming up. And what I need to more worry about is that I should, once I've invested, that idea should do well. So my more challenge is error of commission, which is that any decision I've taken, that should do well for me. Rather than if I've missed an investment idea, it's fine, because every day there are new ideas which will keep on coming up. Based on our understanding, we can invest. So again, I think it is all about introspection on all your successful ideas, investments, and your unsuccessful investments. And the trick is that as long as you're not repeating the errors of your earlier investment decisions, every time there will be a new error, that's fine. But you should at least not learn from your, you should learn from your earlier mistakes and at least not repeat them. I think if you do that, then as an investor, you will become better and better. I don't know.
Right, sir.
Prince,
Yeah,
you got.
yeah, it does answer my question, sir. So one quick question before we take questions from our speakers. We got two, three speakers, and before that, for our speakers, please make sure your questions should not be about any company or buy, sell, hold. You should be asking questions which are relevant to the discussion. So Krishna sir, you were talking about like information these days is in plenty and is more of a commodity, right? So filtering out the useful information and cutting down on the noise, how you go about that, and how we can also like become improvise ourselves on that front, because there is too much of noise, be it social media or the TV or various uh, platforms from where we have been fed narratives, or to say information. So how you make a segregation on that front, sir?
So I think some of these. So one is, I track what is happening in the U.S. market, what is happening on inflation, what is happening on interest rates over there. Do I keep a track of the flows which are coming in from the international investors into India, and why they go out and all that? So at the back of the mind, I'm aware of it, but does that impact any of my stock decisions? No, it doesn't impact. So finally, what I'm trying to say is that these are global macros now. Tomorrow you'll have some geopolitics, and you have to, yesterday you had Ukraine, Russia. Today you have the Palestinian issue and all that. I think that we should not base any of our stock decisions based on knee-jerk reactions to these global macros. I think what you need to be focused on is the work, the workings, the valuations of the companies that you invest in, the sectoral dynamics which can go against you and how that can impact the workings of the company that you invest in. So you should be focused on micro, which is the what are the direct factors which impact the working of a company. So that is one clear cut way of avoiding noise in the market. I mean, now noise in the ecosystem. There's too much of this thing. Second, I think is also uh, whatever the management's commentary is for various companies. I think they will always talk. Most of the time, they will always be talking positive, or rather, they will be always be optimist. That is why they are promoters of the company. That is why they are the CEOs, MDs of the company, and their outlook sometimes on their businesses is 5 years and 10 years, etc. So we as investors, we are minority investors, and our time frame may not be the same as the time frame that the promoters of the companies have. I think you should be vigilant on taking your independent assessment of the prospects of the companies that you invest in. So, which means that you should be looking at competition, you should be looking at how the sectoral evolution, according to you, is happening, and whether the time frame of investing that those companies, those promoters have versus your time frame, do they match or not? I think that is very important. So, there's too much of presentations and call transcripts, etc., available. Uh, you should learn to be able to distinguish what is being said and what does it mean. Third thing is, I think important is that don't get taken in by every quarterly out outperformance or quarterly underperformance of by any company, because that's too small the time frame. And if you look at quarter 1 and quarter 3, you don't even get the balance sheet along with that. So any financial performance reflecting only profit and loss without having an idea on the balance sheet doesn't give you the true picture. So you should look at the company working based on, say, half yearly or full year working, rather than trying to make any assessment based on quarterly numbers. Or at least that is the way I look at it. So net, I would say be aware of the global macros, be aware of national macros, but 99.99% try to make your decisions based on
This space was downloaded via spacesdown.com. Visit to download your spaces today.
the company fundamentals. Yeah, there will be major global events like a global financial crisis of 2008, or maybe those kind of things. Then there is a different atmosphere, and you need to be very careful. But otherwise, I think just focus on company fundamentals, and I think you should be home.
Right, sir. So let's take few questions from our attendees. So Akhil, you can unmute and ask your question. Please make it short and to the point, please.
Yeah, good evening. As we are talking about averaging up or down, generally I've seen myself and others as well that averaging down is quite easy for everyone, but averaging up is a challenging thing. Do we have any book or known article or blog which we can refer to get the insights on past data as well, that how averaging up helps us? Because my holding period is generally longer, so it is also one of the factors in averaging up. So just wanted to know how to get the psychology in sync with averaging up it, because it contradicts with our mindset while averaging up in a security.
Yeah, I'll put it the other way around, Akhil. That do I have any book to share with you? No, I don't have a book to share with you. But I think let's put it the other way around. Is that look at some of the multi-baggers in the last 5 7 years, and imagine that you are an investor in that company at one point of time, and after 6 months, 12 months, the stock has appreciated by 30 50%. And if you would have added more, it will straight give you the answer that it will be very, very easy for you to get an answer on that front. That yes, if you are averaging up with the fundamentals, being aware of the fundamentals, etc., you would have made more returns only. I think that would be a much better way of looking at it, which is how some of the multi-baggers over a 5 year, 10-year period, they would have their own journey. But if you would have invested at some point of time and again further invested after a particular period of time and you still hold on to the stock, you would have seen the returns happening. So that's very, and similarly, it could have also happened that the stock would have corrected and you would have added. My sense is that broadly, if the company is on track in terms of delivering that 18, 20, 25%, whatever earning growth that you believe, then the market fluctuations give you those opportunities to average, to add on the downside or the maybe add on the upside. That's the way I look at it. But do I have a book to share with you? No, I don't have. Sorry.
Thanks, Akhil, for your question. Next is
Thank you.
Siddharth. So, Akhil, any follow up, or you were just closing on your part?
I just wanted to thank you for the answer. No,
Okay,
no
buddy.
more questions.
Thanks. So, Mr. Siddharth, you can unmute and
हाँ सर। सर मेरे को ये क्वेश्चन है कि सर मैं कोई भी शेयर सर खरीद लेता हूँ और उसको मैं रखता भी लॉन्ग टाइम हूँ, लेकिन सर कब बेचना है ये मुझे कैसे पता चले सर कि मुझे अब इसमें से निकलना चाहिए? वो थोड़ा डिफिकल्ट हो रहा सर, उसके ऊपर थोड़ा सा
Good
कुछ
question.
सर आप बताओ।
Thank you for asking the question. I think मोस्ट इम्पॉर्टेंट इज दैट जब भी आप कोई शेयर खरीदते हो तो थोड़ा सा उस पर आपको एक नेक्स्ट 12 महीने, 18 महीने, 24 महीने का एक आउटलुक होना चाहिए कि मेरे ख्याल से इस कंपनी की वर्किंग नेक्स्ट 12 महीने में, 18 महीने में क्या हो जाएगा, कितना प्रॉफिट बढ़ जाएगा, या मतलब क्या ग्रोथ आएगी। और अगर उस हिसाब से कंपनी की वर्किंग पे ग्रोथ आ रही है एंड स्टॉक प्राइस भी परफॉर्म कर रहा है, तो जब भी आपको लगता है कि आपके 2 साल हो गए, अभी थोड़ा इसको फिर से स्टॉक को देखते हैं कि अभी इसमें आगे क्या लग रहा है। अगर आपको लग रहा है कि ये 18-20%, 22% अभी भी और अगले 2 साल ग्रो करेगा, तो आपको स्टॉक बेचने की ज़रूरत नहीं है। बेसिकली कहना ये चाहता हूँ मैं कि अपॉर्चुनिटी कॉस्ट को देखिए, आपके कॉस्ट प्राइस को मत देखिए कि मेरा प्रॉफिट हो गया इसलिए मैं अभी बुक कर लूँ क्या। आप ये देखिए कि आपके आने वाले 2-3 साल में आपको क्या लगता है कि ये स्टॉक मुझे मेरा जो एक्सपेक्टेड रेट ऑफ रिटर्न है उतना मुझे दे देगा क्या। अगर वो दे देगा तो आप उसको होल्ड कीजिए। जब भी आपको ये लगे कि अब ये मेरे को रिटर्न नहीं बनेगा, तब आपको स्टॉक को बेचना चाहिए। या समटाइम्स क्या होता है कि यूफोरिया होता है, आपको लगता है कि जो इसके भाव 5 साल बाद बनना चाहिए उतने जो जिस हिसाब से कंपनी की वर्किंग है, वो स्टॉक प्राइस आज ही आ गया है, 3 साल फॉरवर्ड का डिस्काउंटिंग हो गया है, यानी ऑल द पॉजिटिव्स आर प्राइस्ड इन। तब आपको बुक करना, तब आपको वो शेयर बेचना चाहिए। तो बेचने के लिए आपको थोड़ा फॉरवर्ड जजमेंट लेना पड़ेगा कि इज द स्टॉक डिस्काउंटिंग 3 to 5 years hence, और हैज इट हैव द फंडामेंटल्स चेंज्ड। उस तरीके से फंडामेंटल चेंज हो गए और नेगेटिव हो गया तो आप बेचिए। या आपको लगता है कि भाव बहुत ज़्यादा बढ़ गया है बेस्ड ऑन द नेक्स्ट 3 years प्रोजेक्शन, तब बेचिए। कभी भी खाली कॉस्ट प्राइस को देख के प्रॉफिट बुकिंग के लिए कभी शेयर मत बेचिए।
थैंक यू सर।
प्रिंस, व्हाट
thanks,
इज
Siddharth. So Krishna sir, सेल क्राइटेरिया में कई बार क्या होता है, like when we make an investment and as you were saying कि we keep on monitoring the investment basis quarterly or by quarterly basis, so or maybe 6 months, sorry. तो on the like कई बार ये होता है कि सर आपका डिसीजन सही नहीं है, तो in those scenarios, what do you think, like how much time should we give to the companies basis our investment thought process? Because say if I invested in some company say today, right, and sometime down the line I have to revisit my thesis, but again how much time ideally should be given to a company before making or cutting the losses on that part, sir?
Yeah, I think that it's your individual assessment of the change in fundamentals. And do you think that the change in fundamental or the deterioration in the fundamentals of the business, is it temporary or is it kind of structural or permanent? Now, that is some assessment that you will have to make. So, if you think that some things has gone wrong in your assessment of the business, but this is a temporary thing, or then if you think, then you should take a call and book your loss and look at investing in some other business. But अगर आपको लगता है temporary है, it's not a structural thing that 6 महीने 12 महीने में it will make a comeback, then I think you should hold on to, because then most of the time the company will make up and it will make a comeback. So I think it is a function of why the stock price is corrected, and has there been some structural change in the fundamentals of the business, or it is just a temporary change in fundamentals. See, I'll give you so many examples where you see sometimes this import alert comes in various pharma companies, or some uh, key management change happens, etc. Now, those are various reasons why the stock prices may correct, and it could be unfortunate, like you have invested and these things happen. Now the call you have to take is, what is the resilience of the capabilities of the management to come out of these issues? What is the balance sheet strength of that company? Like for example, let why go far. Like if suppose you have invested in any of the banks, NBFCs 1 week ago, and now this RBI announcement regarding risk weights, etc., has come about, and you saw some correction in the stock prices of many of the banks, NBFCs, by some 2, 3, 4% last week. Now you have to assess is, okay, how big is this issue, and how deep can the impact be on the workings of the various banks and NBFCs. And my assessment is, yes, this is a signaling by the RBI, etc., that okay, you have to be careful about unsecured loans and all that. But is that going to significantly change the fundamentals of most of the NBFCs banks as of now? No, nothing. So then, so I ignore it. Okay, we bought some of these banks or NBFCs and they are down by 3, 4% post an announcement. Yes, but I think after 10 days people will forget about it, because if there is inherent demand for these loans, people will pay a slightly higher rate of interest also. So that's the way you keep on assessing any adverse event in the fundamentals of a company, whether it is permanent or rather very long, or whether it is something which is short term.
And sir, another scenario builds in portfolio, like when you have some good stock and that has multiplied and become say 4 5 bagger or so, and the allocation reaches to a point like that goes beyond, say, if you have set a maximum limit of say 8 or 10%. If that crosses, so how your approach goes in that time? Would you trim that percentage, or you'll keep on riding your winners as long as they are doing good?
My take is that, so why does a stock become more than 10, 15? You start with 3 to 5%, and why does it become more than 10, 15, 20% of your portfolio? It's two reasons. One is the stock itself have done very well, and also it have done better than some of the other stocks in the portfolio. The trick is, I mean, this is a very important question. Good, Prince, that you raised this question. Uh, as far as see, as logical is that risk management, you should have some upper limit, up to which you will allow any position to grow as part of your portfolio. But to start trimming or start looking to trim at say 10% and all, for a direct individual investor, it doesn't make sense. I think he should allow it to ride. Maybe I would say that, can he allow it to ride up to say 15 to 20%? Yes, he should, because whether knowingly or unknowingly, he has latched onto a very big winner. So why you want to just take money off the table? But having said that, you should just exponentially increase your understanding of that company, of that business, of that sector, because now it has become an important 15, 20% of your portfolio. So any development in the competition in that sector, you should be on top of it, so that you can protect your overall portfolio value, and if the need be, you can exit before the market gets an understanding of any change in fundamentals. So that much more effort you will have to put onto that stock, but allow it to ride. Typically, I would imagine that after 20%, maybe you can trim the whatever is excess in that about 20%. But don't look to exit or trim positions at an 8, 10% kind of level. 20% तक चलने देना चाहिए. उसके बाद फिर आपको थोड़ा एग्जिट करना है या ट्रिम करना है as part of risk management, you can do that. But yeah, you should do it. But again, I'm just saying is that keep on increasing your understanding of that sector of that business and write the portfolio to the maximum possible, which could be anywhere between 20-25%. Then you
Right,
will
sir.
and your portfolio will become really big because you held on to a winner. Most of us don't miss out on holding on to big winners. That's what differentiate between the who's who of our investing world versus the average guys.
Totally agree on this, sir. And sir, do you by any chance like use technicals as well as far as the selling decisions are concerned?
It helps. It helps. I'm not saying hardcore technicals, but now if you feel that the stock that you own is showing signs of exhaustion, which means that uh, yeah, so it's not moving up with the market, it is underperforming versus the benchmark indices, etc. So that should be a cause of concern. Okay, am I missing something? So, and uh, and if fundamentals are also showing that some kind of you're having some question marks in your mind, okay, maybe the fundamentals are deteriorating or maybe I'm missing something, then the stock price movement is an early indicator that what you have as a hunch is possibly the market is already signaling. So yes, it always helps to have a, you can say, a secondary confirmation of your of your primary decision. But I don't take it the other way around that the technicals drive my decision. But do I look at it? Yes. But as a secondary to reconfirm what my fundamental thinking is at that point of time.
Great, sir. That really helps. So next is Babulalji. You can unmute and ask your question, please.
Hello, good evening.
Good evening.
So I hold a mixed portfolio, 30, 40 or maybe 50% blue chip, 30% mid caps, and 20% turnaround stories or whatever you call them, risky stocks. Now what is happening because of too many stocks which I have found out and I am having conviction on, the blue chips I'm not able to look after, or the 50% of the portfolio price keeps coming down and up. The real return is not great, and some of the stocks I entered at wrong price. Not trying to make. But I thought I'm parking money, but unfortunately it's turned. Premium.
Yeah, can you? I can hear you. Yeah, please go ahead.
Sorry. So my question is, when you are working on your conviction on mid cap and small caps, is it advisable to give this blue chip or large cap portfolio to a PMS? Because I'm not really able to give attention to it.
Uh,
I want to divide my portfolio into three sections: large caps, small caps, and the risky ones.
See, I'll give you the other way to look at it. That so when you say small caps and when you say mid caps, I think the biggest information asymmetry is in the small caps, where I think the publicly available information on the management track record, etc., is sketchy, or the sectors are small, and so maximum effort you have to put into when you invest is in the small caps because of the reasons that I mentioned.
Okay.
My sense is that if you are able to devote that much of time to building up your small cap and the mid cap portfolio, then I would imagine that you should be able to keep a track of their. I believe when you say blue chips, you're talking of the large cap companies which are a part of the Nifty 50 or Nifty
Yeah, top 100. Let's say top 100.
100. So there is a lot of publicly available information, and you don't require too much of an effort to track them because of the various information which is available. But having said that, I can only say one thing that these 100 companies, Nifty 100 companies are tracked by every senior fund manager. So you have no edge over them in terms of which large cap to buy and which large cap to sell. So to that extent, it would be better that you give it to a professional fund manager to manage that part of the portfolio, and you can possibly devote most of your time to the small cap and the mid cap segment, which requires a lot more effort and which can give you exponential returns also. For large cap, maybe an ETF would be the best way of going about it, which will give you the necessary liquidity and give you a general exposure to the large cap segment.
Thank you, sir. That is what I was looking for. So you have endorsed my view.
Thank you.
Thank you, sir. So next is Priyank Mishra. You can unmute and quickly ask your question, please.
First of all, and thanks a lot, Krishna sir, for your insights and Prince for hosting the space. Krishna sir, I have a question for you. How do you suggest valuing a company which is not profitable? For example, companies that were IPO'd in the last 3 years in the EV space or the fintech space in the US. Uh, it is getting hard for me to valuing those companies as compared to companies who have been in the business for 10, 15 years, where I can see the history.
Good question and a very difficult question. So most of us who have been trained to value companies on cash flows and profits will struggle to figure out. But I think the way to look at it is there are two, three ways. One is the space that these companies are addressing and how big is that space and what is the kind of top line growth that these companies, or top line and maybe EBITDA growth that these companies can deliver in the next 3 to 5 years. If we get a very good sense of the kind of growth that these companies can deliver, then profits will flow. So I think an Indian investors, as investors, I think, or rather, we tend to invest in growth. We are not value focused investors, because most we have opportunities to invest in companies which will grow at 20%, 30%, 25%, etc. And India values, I mean, and you get valuations for such companies. So I think our Indian markets are also now evolving and getting more and more mature to not only look at bottom line growth, but also look we are willing to look at top line growth. And if you think that there is a path to profitability, then such companies will get valued accordingly. So my sense is that look at the size of the opportunity, and then you can get a sense of, okay, for the market cap of the company or for the enterprise value of the company, the size of the opportunity is good, the top line growth is decent, then you can take an investment decision. Like for example, look at the food delivery company, how it has evolved in the last 6 to 9 months, as we have seen the kind of profitability that they are reaching, and how what kind of profits that this company will make in the next year. But look at the top line growth on a quarter-on-quarter basis, YOY basis, and the evolving unit economics.
Got it. Thanks a lot, sir. Yeah, you did answer my question. Thank you.
Thank you.
So, Krishna sir, there are many themes which I mean just kicking off and could be termed as mega trends going forward, be it financialization, energy transition, digital manufacturing. You guys have been very vocal about that. So, broadly, would you like to touch upon these? How we can like look at these themes and position ourselves as far as like the outlook in these themes broadly is?
So I think from a next 10-year perspective, we believe that India is on the just started on the path as far as manufacturing excellence is concerned, whether it is Atmanirbhar, whether it is Make in India, and also China Plus One. So I think that's a broad theme and which covers almost 50 to 60% of the market cap. So typically what we have seen is, if you look at any individual or any mutual fund portfolio, etc., broadly, because of their investments in IT, banking, etc., so almost 35 to 40% of our investments are in that segment of the market. And that's a very reasonably well discovered theme, that segment of the market will also grow. But the kind of tailwind that we see as far as the manufacturing sector is concerned is phenomenal. So a dedicated, so every investor should look at his overall portfolio and see whether he would want to have a bigger exposure to the whole manufacturing opportunity. And when we say manufacturing, it goes across specialty chemicals, auto ancillaries, pharmaceuticals, capital goods. So it's a very vast spectrum, and you have companies across market caps in that segment. So manufacturing is a very important theme that you should be looking to invest in. Then yes, your financialization of savings is again a very big opportunity, which would include segments right from wealth management, asset management, your platform, which are the exchanges, the depositories, etc. And these savings are, we have just started as far as the financialization of savings is concerned, and these are the various players who will benefit out of it, apart from yes the banks, etc. But so this is again another big theme that we believe that investors could look to invest in. So according to me, renewable energy, I mean, and various parts of that segment, that's within the manufacturing, again it becomes an important theme, and this transition is inevitable as far as whether it's solar, whether it is wind power and wind. And it's not only about the generation, but also about the various uh, ancillaries which go with it, whether it's the cables, whether it is the PV cells, whether it's the glass that goes into it. So that whole chain is going to benefit out of it. So these are some of the themes which we believe that from the next 7, 8, 10 year perspective, there are multiple legs of growth that this and investors who broadly on a top down basis, as I said, that these are the themes that we like, and then within that obviously you figure out which are the companies, which are the right valuations that you would like to invest in, and ride this whole macro theme which has a lot of tailwinds.
Right, sir. Yeah, Vipin sir, you can unmute and ask your question, please.
Good evening, Krishna sir. I'm a big fan of yours, and I have seen your journey of MK Global since a long time. So, first of all, congratulations for staying with us for so many years during this financial journey of ours. Thank you for that, sir. So, my question to you uh, in energy transition space. You talked about energy transition just now, like renewable and other source of energy. So, but there are so many players in this field, like they are service providers. There are some equipment manufacturer. So, and there are power producer. There are power transmitter. So, in which area you see the most value lies in down the line for say 5 to 7 year, 10 year time frame?
Good question and very important. I think initially what happens is that so I'll put it this way, that when there was this whole gold rush, it was not the mining companies which made money. It was all those who provided the shovels who made the money. So the initially, I think it's going to be the various equipment guys who provide the ability to set up, whether it's the windmills or the solar power, etc. I think the equipment manufacturers will be the first one to benefit, whether the sector evolves as per our expectations or not, but at least these guys would have benefited out of the supplying the various equipment of setting up the structures which go into it. So I think that is the first way to look at it. And then there will be some of these new technologies which will evolve, where basically on the batteries or on the battery energy, storage systems, etc. So that would be another area where I think you will see a lot of value creation. As far as the generators or the renewable power generating companies are concerned, I think there will be a game of valuation, because at the end of the day it's still an utility. So they are the most capital intensive part of the business. So initially there will be a hype on the valuations, but that's not the segment where we believe that you should be investing in. I think you should be investing in the equipment manufacturers, where there will be the first opportunity, and then some of the new evolving technologies where there could be some multi-bagger opportunities. That's the way I look at it.
Yes, but sir, in my view, the way India is moving ahead and transforming itself.
Mhm.
So, do you think that this utility services turns into some structure story? So it could play a long way in the coming years.
Yeah, I think the whole game is going to be about your cost of money. So,
Yeah.
so I think if your cost of funds are the cheapest, then you will be able to make the maximum uh, capital appreciation. So I think amongst various producers, you have to figure out whose cost of equity is the cheapest or whose ability to borrow is the cheapest, and that will be the differentiating factor. And sometimes as a contra, possibly some of the PSUs which are getting into this space may be at a much more advantageous space than the private sector.
But do you see that as India is moving at very fast pace, so this this story is going to play out in next 10 years, come what may. So because the energy transition is so fast and energy requirement is so huge, the demand is so vast in the coming time frame and as of now itself. So, so this theme could play out in next 8 to 10 years. So, of course, the quality players will stay, and the what I should say, the loose player will lose out more. So, there is a consolidation. There should consolidation happen in this space as well.
Definitely, I think ultimately, initially, whenever there is an opportunity, many kinds of we have seen it earlier also. Maybe 10 years ago, we saw a lot of people setting up thermal power plants and all that, and you know now what happened. Many of them got sold off and went into bankruptcy, and now the whole thing has got consolidated with. And similarly, here also, it will happen that the deep pocketed players, they are the ones who will grow and survive, and there will be many who will possibly set up businesses to sell because there is going to be a valuation multiple that many of these private equity funded opportunities will grow. So then will be consolidators. So वो तो होगा ही. But having said that, I think so the opportunity, as we said, is for the next 5 to next 10 years. There is a very big opportunity, and investors with different time horizon and different different return expectations can participate in the different segments of the market. I think here, I think on this group, basically what we are all individual investors, and we should keep our horizon to 3 to 5 years to start with, and see how we can make the returns from any sector, any segment. And that's where I thought that maybe the equipment manufacturers, etc., could be the better way of going about it. The EPC companies who are catering to this segment, they could be the ones where I'll make my immediate returns.
So there are 3 4 sectors in which India is relying heavily as of now. One is railway, one is this pharma. So just tomorrow, I think, just 2 days before, our minister has told that India will increase its capacity in pharma to 4 times, to $200 billion market cap in pharma manufacturing. So one is railway, one is defense, and one is real estate. So in these 4 sector, what is your view? Pharma, real estate, defense, and railways.
You have hit it on the head. All the 4 sectors that you have talked about, they have very good, robust future in the next from the next 5 10 years. Whether it's defense, whether it's railways, which we have already seen the kind of effort the government has put in. Real estate is one where I think it's the beginning of a cycle, and we are seeing the robust sales which most of the companies are reporting across the country in various micro markets. So that also, and that has a lot of positive rub down effect on various, I think some 100, 200 industries get positively impacted if real estate does well. So real estate also should continue to do well. There only I believe is that because it's very difficult to get the cash flow etc. of most of these companies. Maybe by investing in various building material and ancillary types of businesses could be a much more simpler way of making returns, because uh, valuing the land banks and you never, I mean, the accounting profits and the real profits, they never match each other. So that's a big challenge as far as real estate companies is concerned. Friends, I think we should, it's
Yeah.
almost 9 o'clock now, more than 9 I think.
Sorry, sir. We crossed the time. I mean, sir, on the selling framework, anything which I missed asking you, and you had to say, you can add that in concluding remarks,
I,
and that
I
would be generous of you.
I have one more question, very simple and very precise one. Can you please take it, sir?
Okay, go ahead.
Sir, so as you are one of the oldest and largest desk in the equity market, so you are working with institutional investors. So, what is your learning from the institutional investor as of now?
See, I think you have to, institutional investors, their portfolio creation, their portfolio decision making is very different than how an individual investor can create a portfolio. So I think my learning is that they have their own constraints, right from their regulator, right from their board of trustees, their basically fiduciary responsibility. So, and then they have, so their way of creating a portfolio will be very, very different than how an individual will create a portfolio, because they have to cater to thousands of unit holders. So, my humble request to all individual investors is that you should listen to all the institutional investors, read and understand what they are doing, but not be totally following them in any form. Because of their size, because of their responsibilities, they are a totally different ball. They are in a different ball game altogether. That is my learning. So, as I don't know whether I answered your question.
Yeah, yes, sir. Thank you very much. Thank you. That's what I would like to
Prince,
add. This.
Thanks,
Yeah.
thanks, and thank you so much, Krishna sir, for
Prince,
taking out time
one,
for.
1 minute, Prince. Thank you very much. So, I just thought that you about the selling part of it. I think I'm sure all of you would be monitoring the value of your portfolio. My only humble request to all of you is that when you track your portfolio, don't have a column which also shows you your cost price and gives you a profit, a notional profit. Just keep a tracking of your portfolio is number of the number of shares you own of a company, what is the current market price, and then take a call whether you want to hold on to it or whether you want to sell. Just remove the emotion out of it, which will happen once you are not having the cost price in front of you. That's my learning. That's why I just wanted to share with you.
Thanks, sir. And there are many takeaways from your learnings, be it the idea of knowing about oneself, looking for the size of opportunities, and properly valuing the companies, and consistently monitoring what your companies are doing rather than focusing on the noise in the market. And obviously, as you rightly pointed out, the bet size also matters, because until the needle moves on the portfolio side, it doesn't make any difference. And surely, sir, these themes are surely looking promising, and we as a country should do good. And for that, these pockets which you discussed will surely have to. I mean, we should definitely be investing in those companies. So, thank you so much for your time, sir, and hope we did justice to your time. Thank you so
Thank
much.
you very much. Thank you, Prince, and thank you, everybody. Thank you.
Thank you, sir. Thank you very much.
Thanks.
Thank
Good
you.
night, sir. And for our audience, those who joined late, we have recorded the session and definitely uploading. Will be uploading this on my YouTube channel. So if you are listening Spaces for the first time, you can connect with us, and You can also subscribe to the YouTube channel, which also goes by the same name. My handle Accidental Investor Prince, and you'll find so many great podcasts with the market practitioners who has experience of 20, 30, 40 years. And broadly, we always focus more on talking about the framework of the guest rather than company specific discussions, because that brings more value, and you can always have a scope of including good things in your process, because until and unless your process is right, the returns will not settle down the way you want them. Because the main thing in investing is your process, everything else falls in place. So with this note, I thank you. Thanks everyone for keeping with us for so long, and thank you Vipinji and other speakers for their thoughtful questions so as to drive the session. Thank you so much, guys. Good night, take care.
Good night, guys.
This space was downloaded via spacesdown.com. Visit to download your spaces today. 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 Download your spaces today.